People are signing longer leases right now, and investors are looking to sign longer leases right now with tenants than they have at any point in the last 9 years. Round up, call it a decade.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses.
What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. In this quick solo episode, I'm going to be discussing three recent pieces of market news, really three topics of multifamily news that I find to be interesting right now. I think a lot of the listeners will find interesting as well, as it relates to what is actually occurring in the multifamily sector, in the multifamily market right now. And this is news that's relevant regardless of what market you're operating in. So this is nationwide commentary here, and we're going to do a little bit of current events discussion, or have a bit of a current events discussion in this episode. And again, I'm going to touch on three different pieces of news here. First is just the concept of lower cap properties trading at larger discounts. And this isn't necessarily a piece of news. It's just a trend, something that's occurring in the marketplace. But really nationwide, a lot of very successful investors, folks that are operating on a completely different plane. You know, I'm talking about like the John Grays of Blackstone, like who runs the Blackstone real estate division. I mean, probably the most successful real estate investor in the United, just in the country. Barry Sternlichs with Starwood. Even a lot of smaller investors relative to those folks, but people that have syndicated assets for 10, 20 years that I respect. One of them being Keith Wasserman and Gelt, it's a California-based firm. His firm is buying large 150 plus unit communities throughout the West Coast, California, Arizona, Utah, Colorado. They've bought 10,000 plus units, I think. At least that's what I remember their portfolio size being. Long story short, a lot of the most successful investors I know are regularly talking about how they're seeing assets trade at 20, 25, 30% plus discounts off of peak pricing, which is mid to late 2021. Now, a lot of people are listening to this going, hey, that's not what's happening in my market. That's not what's happening in my backyard or where I invest or with the types of properties that I buy. And I would also be one of those people. That is something that I would say as well. Yes, pricing has leveled off, at least from a growth rate standpoint, if not actual pricing itself in the markets that we buy in. And then you have a market like Florida where, pricing's considerably down across every single market, across every different asset class, because of the fact that insurance has completely decimated that market in general. And generally speaking here, lower cap rate properties, and this is what I'd like to communicate here. Lower cap rate properties are going to see their pricing be significantly more affected than higher cap rate properties. And I'm going to share a quick piece of data here to actually illustrate what I'm talking about. But when we think about the properties that these large groups are buying, typically they're Class A or Class B properties. Blackstone and Barry Sternlichs, that's Starwood. A lot of these larger investors are not buying C-class assets like 1960s, 70s C-class properties. They're not doing that. They're typically buying properties built in the last 20 years that are B or A class, and they're buying larger communities, 200, 300 plus unit communities. Now, those properties in general trade closer to what's happening in the capital markets than your 1960s C-class asset or your small to mid-sized multifamily property. And basically, those large properties being pursued by the most successful investors in the country are basically just levered bets on that macroeconomic environment in that specific market. These investors aren't buying 300 plus unit Class A properties in tier one core markets throughout the country for deep discounts. Like, they're not doing that. They're basically buying at market at every point in the market cycle. And interest rates dictate what those investors pay at a very significant level, and much more so than, again, a lot of us who are buying the 20 to 50 to 100 unit stuff that's Class C, that's maybe not in these core markets. So as a result, cap rates compressed an insane amount, as we all know. And as interest rates basically doubled, right? I mean, the borrowing rate went from in the threes for a lot of these folks or for a lot of these deals to in the sixes or the low sevens. There's such a massive gap there from a deal that was trading at a 3.5 or a 4 cap to, and basically we were borrowing at your cap rate. Now interest rates have doubled and you're borrowing at, call it 7%. You obviously it just doesn't make any sense to pay 3.5 cap, 4 cap values for those assets. And those cap rates have expanded to 5.25, 5.5, according to research. And again, I'm just speaking generally throughout the country. And what I'm trying to communicate here is properties that are more premium, Class A, Class B, in better markets, that trade at lower cap rates relative to where real estate trades throughout the country. Those properties are significantly more affected when cap rates expand than, for example, the C-class stuff in the secondary markets that, maybe they got down to trading in the high 5 cap range, 5.7, 5.6 caps, whatever it is, right? I'm just, again, using numbers for an example's sake here. If those cap rates expand to 7, they go from 5.75 to 7 or something along those lines, it's much less of an impact on the value than a 4 cap asset, property that was trading at a 4 cap, then trading at a 5.5 or being valued at that. And so some quick numbers here. I'm just, reading it off of some calculations. This is an Instagram post I put up about a year ago. When a property that trades at a 4% cap rate, if the market cap rate in that area, let me actually frame this in a little bit more of a simplistic way. A property valued at a 4 cap that is then valued at a 5.5 cap, if cap rates expand in that marketplace, has lost 27% of its value. And that specifically is what happened in many markets for many different product types. Class A and B properties, maybe they were trading at a 4 cap. Interest rates ran up. Now we've sat in an elevated interest rate environment for over 2 years now, or it's been at least 2 years since rates started to increase. And let's say that asset would trade at a 5.5 cap. Well, that's a 27% reduction in value, assuming the same, net operating income. Now, to speak, to kind of share the other example, let's say we have a property that trades at a 7 cap and cap rates have expanded to 8%. And they probably haven't, they've probably expanded it slightly less given the fact that they've maintained, it's been positive leverage in that type of asset, even though rates have continued to increase. So let's say this is a Class C deal. You're in some Midwestern market, right? And values went from 7 cap to 8 cap, right? I'm using numbers here. Well, that's roughly, it's roughly a 10% value reduction. And that's not nearly as severe as going from, 4 to 5.5. Let's even, use a bigger example. Let's say we're going from 6.5 to 8. Well, a property that has $100,000 in NOI that trades at a 6.5 cap is worth $1.53 million, give or take. $100,000 in NOI and an 8 cap, 1.25. Again, so we're a little over 10% there, a little bit higher than that. Still, cap rates increased 1.5%, but it's a significantly lower percentage of that property's value than going from 4 to 5.5. So long story short, and again, this is a little bit of a, some cap rate education here that some people might already understand, but pricing has been significantly more affected at the top end of the marketplace as it relates to properties that trade at lower cap rates, which are typically the higher price per unit buildings that are more recently built in better markets. So when you see news being released by the Real Deals, the Real Pages, the Multifamily Housing News, whatever, Wall Street Journal, whatever the publication is, that commercial real estate pricing is down 20, 30, 40%, and you're like, hey man, that's not what's going on in my market. Well, it's probably because they're talking about the institutional segment of the marketplace. They're probably talking about more core markets, and they're probably talking about properties that are just more premium than what you're buying. Second piece of news that I think is interesting is how significantly multifamily starts, which is the industry term for new development, has plunged over the last 6 to 12 months. I mean, really the last year plus. Big reason. Low interest rate environment of 2020, 2021 into 2022, even going back to 2018, 2019. Inflation's going through the moon. Rents are going up. They're going nuts. Borrowing cost is extremely low, so that developers can borrow money at a very low interest rate, and they reduce their project cost. A lot of real estate was, and there was a lot of real estate that started being constructed. There was a lot of multifamily starts from 2020 to 2022. Now, from 22 to now, June of 2024, which is when I'm recording this, that has plunged. Jay Parsons of RealPage, who I think is one of the best LinkedIn follows that you can have if you're in this game, he dropped some information. This was a couple of weeks ago that was very revelatory, where basically, and I'm reading verbatim, multifamily starts annualized and seasonally adjusted. So this data is very thoroughly categorized and communicated, is less than half of what they were 1 year ago. So down by more than 50%. And that is the biggest year-over-year drop since the great financial crisis. So in over, basically 15 years. So when we look at the actual data, total starts in recent months are looking more like 2012 and 2013 than 2015 to 2019, and it's below 300,000. So that's the number of units that are being started as it relates to projects that have been improved and construction has started. And that's basically the lowest that's been in over a decade. And that has insane implications as it relates to rent growth and projecting rent growth over the next 5 to 7 years in whatever market that you're buying in. Now, this is a nationwide piece of data, and this is going to be constant everywhere because the fundamental drivers for the reduction in multifamily developments is because of interest rates, primarily speaking, and because a lot of the markets that had the highest development numbers, which are a lot of the Sun Belt markets where it's easy to build, business friendly, a lot of land, all the demands metrics that cause somebody to want to develop, cause an investor to want to entitle a project and build. There's a lot of people buying, and not a lot of people want to be delivering, or there was less of an interest in delivering a new development in a market where there was a lot of supply already being built. And now investors who can develop projects and can make sense of these higher interest rates, they're going to be completing projects in a higher rent growth environment where they're competing with less new supply. So it actually is a good time to be a developer. But for the buy and hold folks out there, which are the predominant listener base of this podcast, it's something, you shouldn't drastically change your rent growth assumptions, but there should be a level of understanding that if rents have reduced in your market or they flatlined in your market and you think that it's, and you are an investor that's buying product that somewhat competes with new supply, which I would consider anything B minus plus, C minus class housing is really not competing with A class housing. But again, rising tide lifts all boats. New supply reduces rental rates throughout because there's fundamentally just more. There's just more units to be absorbed by the population in that market. So it's still going to affect you even if you're buying Class C property. It's likely that you're going to see rent growth rebound in 2025 and the subsequent years because of the fact that so few developers are starting projects right now. Third piece of data is less impactful as it relates to what's going on in the macro market, macro multifamily market, I should say, but one that I found very interesting. Again, Jay Parsons' Real Page dropped this. The average terms for new leases signed in April 2024, so this is April 2024 data, hit 12.7 months, so over 12 months, which is down a little bit from a long-term high of 12.9 in February. And this is a long-term high over the last 9 years. So I'm looking at a graph from 2015 to April of 2024. Two highest months were February 2024 and April 2024 with that 12.9 months and 12.7 months. Now, this isn't a massive piece of news, but in many specific months throughout this graph, average lease term was anywhere from 10 and a half to 12 months. A lot of months a lot of average lease terms throughout the different months that they started tracking this data are in the 11s. So long story short, people are signing longer leases right now, and investors are looking to sign longer leases right now with tenants than they have at any point in the last, 9 years, round up, call it a decade. And it's an interesting piece of data because of the fact that if you are a tenant, if you're somebody who's listening to this, I rent, you might be in a position to actually better secure a better price on renewal if you're actually going out there and signing a longer lease on renewal versus something around 12 months. Reason being is that multifamily operators right now want to secure tenants for a longer period of time because of the fact that there is a lot of supply being added in many markets throughout the country. And most owners right now would rather trade top line rents or just the base rent price for a specific unit for a longer occupancy so they can see through this period of delivers from a multifamily development completion standpoint. All these units coming on the market, a lot of investors right now are just they just want to maintain high occupancy. They just want to maintain solid income and maybe not maximize the rent growth, even at the expense of long-term asset growth because of the fact that they're leasing up units at a slightly lower rate. They're going to have to work a little bit harder to get them up to call it market rent pricing on renewals. But in the short term, this is something that multifamily owners are doing a lot of. And in our business, we're doing the same thing. We have been offering longer term leases to folks and been happy to sign at slightly lower rates. If I can sign a 15, 16-month lease with a tenant and give them a 2-3% reduction in the top line rent price, I'm more open to doing that now, especially if that lease expires in a peak season, which in most of our markets is anywhere from April to September. I'm more open to doing that now than I ever have been since I've been in the real estate business, really since 2016, which is also coincidentally when we're communicating this data. So if you're an owner, you should think about signing longer term leases with tenants. You probably should think about doing what a lot of the extremely large operators are doing who are the best at this. Again, this is a bit of a sidetrack, but when we think about what do the best investors do, we should probably be looking at what they're doing and trying to do something similar in our business. Best investors being the largest owners, the equity residentials, the Gray Stars, the Bizzutos, a lot of the larger management companies, they're signing longer leases. And if they're doing that, there's probably some reason behind it because they like to make money and we do too. So we should probably be taking what they're doing and applying it to what we're doing in our business as well. So interesting piece of data though, as it relates to average length of new leases signed. Longest it's been basically in the last decade. But those are three pieces of news, three trends that I thought would be interesting to at least discuss in kind of an open format here in this episode. And to summarize what we're doing differently in our business comparatively to what we have been doing, and I should say I'll relate it to what I just talked about in this episode. Most of the deals that we're looking at where we're seeing more of a discount to value or the more premium properties, right? The B class, the more recently built, which in our market is really anything in the last 40 years is recently built because of the fact that the housing stock is predominantly early 1900s. And that's where we're starting to see better opportunities as it relates to a discount from previous purchase. Significantly more so than the higher cap sectors of the marketplace in terms of Class C, older buildings, et cetera. There's less discounts to last purchase, call it 2020, 2021, et cetera, because of the fact that those properties trade at a higher cap rate anyway, and because people can just still buy with positive leverage when they're buying those assets. We're starting to get a little bit more aggressive with our rent growth assumptions throughout a longer term period of time. I feel a little bit more comfortable using maybe a 2.5-2.75% rent growth figure throughout a hold period on an asset that we're projecting a 5-year hold on and doing a more intensive underwriting on, because of the fact that there is still a supply shortage in the markets we're buying in, and they're relative to supply being added over the last 10 years. A lot of it's been in the last few years because of ultra low borrowing costs and rents increasing to a point to where supply started to pencil a little bit more. But when that tapers off, because we still have growth in the markets we're buying in, it's going to significantly impact the number of units available to residents in those specific towns and cities. And I think that we're going to see rent growth pick back up in a more meaningful way. So we're starting to get a little bit more aggressive there. And then from an operational standpoint, we're very open to signing longer leases with tenants, much more so than we have in years past, knowing that if we sign a 12-month lease with a tenant, rents are probably going to have elevated at a point in 12 months to where if we trade that lease out, we're going to see real growth. We're not afraid of that, but now we're in a serious mode of reducing vacancy, increasing occupancy, increasing length of average tenant stay, even if it means we're giving up a little bit on the rent roll. So hopefully you learned something in this episode, or you found this episode to be valuable. And if you did, please consider sending it to somebody in your network, a friend, a colleague, a business partner, whoever it might be. That helps the show grow. And obviously that's our objective when putting these episodes together, is to get in front of more folks and to help more folks invest more wisely. But again, thank you all for listening to the Multifamily Wealth Podcast, and I'll catch you guys on the next episode.